Hello and welcome to the second episode of our educational video series, The Learning Curve, where you will find a simple solution to certain very common yet complex issues and concepts. Today we are covering a very important aspect regarding taxability of gifts. India does not need a season of festivities. They are regular events which run through the entire calendar. In addition, there are weddings, anniversaries, and birthdays, and all these events revolve around gifts from relatives, friends, professional colleagues, and others. Have you ever thought of paying taxes on these gifts? Don't worry, we're not asking you to do that, but we intend to empower you with the technical information so that you can take a rational call. In every gift transaction, there are two parties: donor, the one who gives a gift, and donee, the one who receives a gift. However, implication of tax payable in case of gift arises only in the hands of recipient or donee and not the donor. Now let's understand the type of gifts with the help of a few examples. Any sum of money received without consideration is a monetary gift. Certain movable properties as per IT Act received without consideration is a gift of movable property. If such movable properties are received at a lower price, it can be said that such movable property is received for less than its fair market value. Immovable properties received without consideration can be termed as gift of immovable property. In case Mr. B pays a reduced price for such property, then it is said as immovable property received for less than its stamp duty value. Fair market value is the price at which an article can be reasonably sold in the open market. Stamp duty value, or SDV, is the value adopted by any authority of the central government or a state government for the purpose of levying stamp duty on an immovable property. Let's go back to history. As we all know that Gift Tax Act 1958, which was introduced in the budget by none but India's first Prime Minister Mr. Jawaharlal Nehru, who was presenting his first budget as the Finance Minister, was later repealed in 1998. So does it mean that receipt of any amount or article as gift is exempt from tax? The answer is no. Gifts are now taxed under the Income Tax Act 1961. Taxation of Gifts. Taxation of gifts depends primarily on, number one, who is making the gift, and it could be anyone, individual, HUF, AOP, BOI, or a company or trust. Number two, the occasion when the gift is received. Along with the charging provisions of gift under Section 56(2)(7) of the Income Tax Act 1961, there is a proviso attached with relation to exemptions being provided to the recipient of gift. As per the exception, there is no incidence of tax in case the gift is received from any relative on the occasion of marriage of the individual, or under a will or by way of inheritance, or in contemplation of death of payee or donor, from any local authority, from any fund or foundation or university or other educational institution or hospital or other medical institution. For the purpose of above exemption, relative means spouse of the individual, brother or sister of the individual and their spouses, brother or sister of the spouse of the individual and their spouses, brother or sister of either of the parents of the individual and their spouses, any lineal ascendant or descendant of the individual and their spouses, and any lineal ascendant or descendant of spouse of the individual and their spouses. As per an explanation to Section 56(2)(7) of the Income Tax Act, there is a list prescribing 10 different gifts that need to be declared on which tax to be paid when received in personal capacity. These include cash, bullion, jewelry, shares, financial securities, drawing, paintings, and immovable property. These need to be declared under the head Income from Other Sources and taxed accordingly. The other popular items used as gifts, including mobiles, tablets, and other electronic products, don't need to be declared if received in personal capacity. Let us take some examples to understand taxability of gifts. Mr. A receives Rs 49,000 as gift from people other than immediate family members. This amount is not taxable as it is less than the exemption limit of Rs 50,000. Suppose Mr. A gets gifts worth another Rs 10,000 from similar sources, then the total value of gifts, which is rupees 59,000, would be taxed as income from other sources. Also note one interesting point that while wedding gifts are tax exempt, gifts above rupees 50,000 received from unrelated persons during engagement are not exempt. In a real-life example, it was held that bonus shares received by a shareholder cannot be taxed as gifts in the hands of recipient, as any profit derived by assessee on account of receipt of bonus shares has been offset by depression in the value of the equity shares already held by him. Bonus shares do not result in the recipient getting a property without consideration or for inadequate consideration. Deputy CIT versus Dr. Rajan Pai, 2016. Income accrued from gifts. What if a recipient is earning income from exempt assets or resources? Even though gifts received during wedding or otherwise are not taxable, but income earned from such gifts is taxable. For example, Mr. A receives a farmhouse as wedding gift from his father-in-law. Mr. A rents out the same farmhouse as marriage venue and earns income. Such income will be taxable. Similarly, if Mr. A sells the farmhouse, he will also have to pay capital gain tax. Gifts from spouse. Let's assume a woman receives cash from her husband, which she invests and earns interest on. Such interest income will be taxed as income of the husband as per the provisions of Section 64(1)(2) of the Income Tax Act. Clubbing provisions of the spouse is mentioned under Section 64(1)(2) of the Income Tax Act 1961. However, if the income is reinvested and generates further income, this fresh income would be taxable in the women's hands. Gifts received in professional capacity. Section 28 of the Income Tax Act lays down what is taxed as business income and includes the value of any benefit or perquisite, whether convertible into money or not, arising from business or the exercise of a profession. For example, Mr. A, a chartered accountant, receives a car from his client. Tax has to be paid on the FMV, that is fair market value of such car. We hope this video has helped you to understand the basic principle of taxation of gifts so that you will remain more alert next time while receiving a gift. Thank you so much for watching TIOL Tube.